Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. There are two things in the New York Times article on long-term care insurance that they almost got right. Half-truth number one. The New York Times article on long-term care insurance states, by 2020, sales of traditional policies had dropped to 49,000, and the number of carriers offering policies had fallen to fewer than a dozen from more than 100. It's true that over 170 insurance companies used to sell traditional long-term care insurance. It's also true that fewer than a dozen companies still sell traditional long-term care insurance. However, most of the companies that stopped selling long-term care insurance stopped selling it around 2002, over 20 years ago. The number of companies selling traditional long-term care insurance since 2002 has been relatively stable. It's been about 10 to 15 different companies in most states at any given time. The question the New York Times article should have asked is this: why did so many companies stop selling long-term care insurance around 2002? There are four main reasons. Number one, as I mentioned previously, in order to try to prevent rate increases on newer long-term care insurance policies, in December of 2000, the National Association of Insurance Commissioners created a new regulation for long-term care insurance pricing. This regulation was named the Rate Stability Regulation. The regulation created several new rules that would lead to more stable rates for long-term care insurance over time. The biggest rule change was the profit incentive was removed from rate increases. States began to adopt this regulation in late 2001 and 2002. By early 2003, the two biggest markets for long-term care insurance, California and Florida, enacted the rate stability regulation. Most insurance companies did not like this. They stopped selling new long-term care insurance policies. Also, interest rates dropped after 9/11. Long-term care insurance companies collect premiums and then invest those premiums in safe government and corporate bonds. They collect the interest from the bonds and use it to help pay all future claims. When interest rates dropped after 9/11, many insurance companies determined they could not profitably sell long-term care insurance. Thirdly, the mortgage crisis in 2008 prolonged the low interest rate environment and prevented companies from re-entering the long-term care insurance market. Lastly, to reduce overhead and to achieve economies of scale, over the past 30 years, the insurance industry, like most industries, has consolidated. Many of the companies selling long-term care insurance merged with or were acquired by other companies selling long-term care insurance. One long-term care insurance company in particular acquired over a dozen smaller long-term care insurance companies. Also, many insurance companies can make higher profits by selling life insurance as a solution to long-term care rather than selling long-term care insurance. That's why if you ask 20 insurance agents for information on long-term care insurance, 19 of them will probably give you information on life insurance. Again, the New York Times got this half right, that by 2020, sales of traditional policies had dropped to 49,000, and the number of carriers offering plans had fallen to fewer than a dozen from more than 100. The article leaves out that in 2021, nearly 500,000 people in the state of Washington purchased some form of private long-term care insurance. They were given a choice between contributing to a state-run program called the Walk Cares Fund or purchasing a private long-term care insurance policy. The vast majority of higher income earners in Washington chose a private policy rather than a state-run program. They discovered that private long-term care insurance would, in most cases, provide richer benefits for less premium than the state-run program. Why didn't the New York Times mention that? Half-truth number 2. Quoting the New York Times article, they said in 2021, about 30% of applicants aged 60 to 64 were denied long-term care insurance. Then they said for applicants aged 70 to 74, the rejection rate was 47%. Then they continued, even among people in their 50s, more than 1 in 5 were turned down for a long-term care insurance policy. Chronic health conditions, it continued, a history of stroke or diabetes or psychiatric illness may all be grounds for disqualification. Again, this is something that is half true. A lot of applications are declined. However, it's not because the insurance companies have tightened their underwriting. The opposite is true. For many health conditions, long-term care insurance underwriting has become more lenient over the past decade, not stricter. There are 3 main reasons so many applicants are declined today. Number 1, investment advisors often don't discuss long-term care insurance with their clients proactively. Their client has a health change and then brings up the subject to their investment advisor, and their advisor, unfortunately, at that point says it's often too late. There's nothing we can do. We'll try to submit an application and see what happens. Number 2, many famous financial pundits today recommend waiting to buy long-term care insurance until age 60 or 65. Unfortunately, many people develop chronic health conditions before age 60, so they're unable to buy a policy. I became uninsurable for long-term care insurance at the age of 58. Thankfully, I purchased a quality long-term care insurance policy in my 40s. In general, consumers don't understand much about long-term care insurance. I had a call the other day from a woman who wanted to buy a long-term care insurance policy for her husband, who had just had a stroke and was in a skilled nursing facility getting rehab. And she said to me, he's coming home in about 30 days and I need a policy to pay for a home health aide to care for him every day. Sadly, I had to explain to her that her husband was uninsurable. He could not get long-term care insurance. Her reply was interesting. She said, but the Affordable Care Act does not allow someone to be denied insurance. I explained to her that the Affordable Care Act only deals with medical insurance. The Affordable Care Act does not regulate other types of insurance, does not regulate life insurance or disability insurance or long-term care insurance. In the next episode of our in-depth analysis of the 2023 New York Times article on long-term care insurance, we'll discuss what the New York Times got right.